Welcome to the Deep Dive, the show where we take those dense earnings reports and, well, we cut right to the chase.
Exactly. And today we're looking at CarGurus Inc., ticker CARG. We're digging into their Q3 2025 results from that call on November 6th.
And this one is fascinating. I mean, you've got a company that feels like it's telling two completely different stories at the same time.
That's the perfect way to put it. Our mission here is to really untangle those two narratives. On one hand, you have this incredible high margin performance from their core business.
The marketplace, right.
The marketplace. And on the other hand, you have this very, messy but totally necessary strategic pivot going on.
It's that classic addition by subtraction idea, but the market, well, it always has trouble pricing that kind of thing in real time.
It does.
So let's start where they started on the call, the headline numbers. Because, despite all the noise, they really did deliver a strong beat.
They absolutely did. So total revenue came in at $238.7 million. That was just a little bit ahead of what everyone was expecting.
A slight beat.
A slight beat, yeah. But the bottom line, that's where you really see the power of this transition. Their GAAP EPS hit 45 cents.
45 cents. And if you look at that year over year,
it's a massive 114% growth, just a massive.
It's a huge leap. That beat the street by 4 cents? And then on the non-GAAP side, which, stripped out some of that restructuring stuff.
Right, the cleaner number. They reported 57 cents, which was, again, comfortably ahead of the 55-cent consensus. These are just knockout profitability numbers.
But the numbers alone, they don't really give you the full picture, do they? We have to talk about the margins because this, to me, this is the clearest sign that they're getting back to their roots.
Yes, back to being a high-quality software company. Consolidated gross margin, get this, reached 89%.
Okay, stop there. 89%. Most companies would kill for 50%. When a company is approaching a 90% gross margin, what does that tell you?
It tells you that it's a different kind of asset. It fundamentally changes the conversation. You stop being valued like a cyclical auto company that's actually touching cars and taking inventory risk.
And you start getting priced like
a high-growth, asset-light software platform. And that huge jump, that's a direct result of them shedding that capital-heavy wholesale business.
And you see that efficiency just flow right down the income statement. The adjusted EBITDA margin, it expanded by nearly 500 basis points year over year.
Up to 33% consolidated. It's just a powerful, powerful validation of the decision to simplify and focus.
It really is. And yet, for all these operational home runs, the initial reaction from the market was kind of a shrug. A little bit muted in after hours.
It was cautious, yeah.
So what's the disconnect? They're guiding up, they're delivering these insane margins. Why are investors still sort of sitting on their hands?
I think it's two things. First, you can't ignore the macro picture. It's genuinely tough out there, right? High interest rates are really hitting auto affordability. And second, there's always a bit of, let's call it skepticism after a big, messy pivot like this. Investors want to see a few clean quarters. They want to see that the CarOffer noise is completely gone before they jump back in and re-rate the stock higher.
That makes sense. Show me, right? So let's move from the headlines to the engine room, the marketplace segment. This is the core business.
This is the fortress, exactly. And its dominance is only growing. So marketplace revenue specifically grew 14% year over year to $231.7 million.
And the margins inside that core?
Still incredibly robust, a 36% adjusted EBITDA margin for the segment.
So the engine is definitely humming. But how are they fueling that growth? Is it just signing up more dealers, or are they getting more money out of the ones they already have?
It's both, which is exactly what you want to see. It suggests real stickiness. Total paying dealers, that number was up 6% year over year, over 33,600 globally.
And I saw a detail in there, that U.S. dealer count growth.
Yeah.
It's actually been accelerating.
For 4 straight quarters now, it shows that the U.S. marketplace is still deepening its moat. It's not just sitting there as a mature business.
And then there's the other side of it, how much they're getting per dealer. Let's talk about QARSD.
Right. The consolidated quarterly average revenue per subscribing dealer. That number hit $6,500, up 8% year over year.
And QARSD is so important because it proves the value prop.
Right.
Right? When dealers are willing to pay you more, it's because your product is working for them.
Exactly. It's delivering results. And management pointed to three core trends in the U.S. that are driving that.
Okay, what were they?
Well, they really paint this picture of compounding growth. First, your existing long-term customers, they're consistently spending more over time. They trust the platform.
Sort of moving up the tiers.
Right. Second, new customers who are just joining are actually signing up at higher price points, higher average order sizes than older groups did.
So the starting point for a new relationship is already higher.
Precisely. And the third point is maybe the most powerful. These newer groups, these new cohorts, they're ramping up their spend faster than the legacy ones did.
Wow. So the new products are proving their value much quicker.
It's accelerating their entire monetization curve. I mean, it is the textbook definition of a healthy flywheel.
Okay, so the U.S. is the cash cow.
Yeah.
But what about international? I saw some really impressive momentum there, especially in the UK and Canada.
Oh, yeah. International revenue was up a sharp 27% year over year. And their main metric for that, what they call international CARID, basically consumer visits, that was up 15%.
And that's not a one-off.
Nope. That's their 9th straight quarter of double-digit growth in those markets.
What I find fascinating, though, is their strategy there. Management basically admitted they're keeping prices lower outside the U.S. on purpose. Why would you sacrifice that short-term margin?
It's a classic land grab strategy, a market entry playbook. They are prioritizing market share and, building up that consumer liquidity against local incumbents.
So get the eyeballs first, then worry about the money.
Exactly. They know that once they hit that critical mass, they can just flip the switch and implement the high monetization U.S. model. They're sacrificing a little bit today to build a huge profit engine for tomorrow.
All right, let's talk about that sacrifice. Because this whole transition hinges on them winding down that capital-intensive part of the business, the CarOffer segment.
And that wind down is almost done. The numbers show it clearly. Wholesale revenue, where they were actually, buying and selling cars, that fell 81% year over year.
Down to just $2.2 million.
They are out of the inventory risk business, period.
Which sounds painful, but the addition by subtraction part is that the operating loss in that segment narrowed 63%.
It narrowed to negative $9.4 million. It just validates the entire pivot. And management confirmed the future for wholesale is purely asset light. It's tech, it's data, it's analytics for dealers. No inventory risk for CarGurus at all.
And they said they're going to recast that whole segment as discontinued ops in Q4, which is great news for investors. It means the financials are just going to look so much cleaner going forward. Yes, but this is where it gets really interesting for me. The capital they freed up isn't just sitting there. It's being plowed back into software, into AI, and it's massively expanding their total addressable market.
This might be the single most important part of the entire call. CarGurus is not just a lead gen website anymore. They're moving beyond that, $3.5 billion U.S. marketplace.
And they're targeting what?
An additional $4 billion market. For dealer software, for data products, for workflow solutions, they want to be the entire operating system for the dealer.
From just a great website to the central intelligence hub for a dealership. Let's get into those AI products because they sound genuinely game-changing.
They're very sophisticated. Okay, so take PriceVantage. It's their new AI pricing tool. It uses real-time consumer demand data, which nobody else really has at their scale, to help dealers price cars optimally.
And the early results.
Engaged dealers in the beta saw a 5x improvement in inventory turn time. 5 times.
A 5x improvement in turn time. I mean, that's like pouring rocket fuel on a dealership's P&L. If your inventory is moving 5 times faster, that is a monster competitive advantage.
It is. Then you have the consumer-facing AI, CG Discover. This is their conversational generative AI shopping assistant. So it's not just a bunch of filters, it's a real-time guide for the buyer.
And the results in that were kind of staggering. They said usage saw explosive growth, but the conversion stat is what really got me.
The 6,000 basis point higher VDP to lead conversion rate.
Yeah. Can you just translate that for us? What does 6,000 basis points actually mean here?
It means that a lead from the AI assistant is about 60 times more likely to convert into an actual sales lead for the dealer than a standard click. 60 times.
That is it's an insane indicator of intent. The quality of that lead must be off the charts.
It has to be. And then finally, they solved one of the oldest problems in the car business, connecting what happens online to what happens on the lot. They did it with a thing called dealership mode.
Dealership mode is just genius. It's a geofenced feature in the app, right? So it only activates when a consumer is physically on a paying dealer's lot?
Correct. And when they're there on the lot, it gives them real-time pricing comparisons, validation. It confirms they're getting a good deal.
So while the salesperson's trying to close the deal, the customer is literally on the CarGurus app, which is telling them this is a good price from this specific dealer. It's perfect sales attribution.
It turns the customer into an ally for the platform. It's brilliant. And this AI focus, it isn't just for new products, it's saving them money internally too.
Right. They said AI tools are handling nearly 80% of their managed chats now.
Which let them cut their outsourced engagement team by 40%. So AI is driving margin expansion and top-line growth at the same time.
And all of this strength, all this confidence, it translated into a big guidance raise for the future.
It sure did. They raised Q4 non-GAAP EPS guidance above the street. And for the full year 2025, they lifted their non-GAAP EPS guidance to a range of $2.19 to $2.25.
That is a massive raise.
Yeah.
That implies
What?
29 to 32% year-over-year growth. The old consensus was way down at like $1.98.
It's a huge beat and raise. And normally that kind of guidance raise with this margin story, that sends a stock soaring.
You should. And they're juicing that EPS growth even more with buybacks.
Aggressive ones. They bought back $111 million stock in Q3 alone. And since this started the program in late 2022, they've retired 23% of all their shares.
23% of the company is gone. That's a powerful lever that just amplifies all the good things happening in the core business.
So we come back to that original tension. Amazing performance, huge guidance raise, massive buybacks. But the stock is just sort of treading water.
It really feels like the market is just saying, show me. Give us a few clean quarters, prove the macro environment won't kill your marketplace, and prove this $4 billion TAM expansion is for real.
They're still being treated like a cyclical auto company with transition risk, not a high-growth software company. But that lag, that waiting period, that's where opportunity comes from.
I agree.
The takeaway for an investor seems pretty clear. The stock is lagging because of perception and timing, not because the business is weak. And once the financials are totally clean, that stock multiple, it should re-rate significantly.
The evidence definitely supports that thesis. Which brings us, of course, to the segment where we explore how you might just monetize that gap in perception.
This is not financial advice.
This is not financial advice. We're just using the data from the call for informational and entertainment purposes to build a hypothetical trade idea.
So given everything we've talked about, the thesis is simple. The market is mispricing CARG. You've got 89% gross margins, accelerating EPS, but it's valued like a low-margin cyclical business.
So we want to bet on that quality improvement and the multiple expanding. How would you structure a trade for that?
Well, you could do a relative value trade. You go long CARG common stock because you believe the market will eventually wake up and re-rate it closer to its SaaS peers.
Which trade at much higher multiples.
Much higher. But to hedge out that general auto sector risk, the high interest rates we talked about, you could simultaneously short an equivalent position in a more capital-heavy, lower-margin auto tech name.
So that way, if the whole oil market takes a dive, your short position protects you. You're left with a pure bet on TierGarg-specific superiority.
Exactly. It isolates the company-specific thesis. Now, for an options play, we mentioned that the CarOffer noise is keeping implied volatility a little bit elevated.
You can monetize that.
You can, by selling out-of-the-money puts. For example, you could sell puts at the $30 strike, which is comfortably below the current price of around $34.60.
And you collect a premium for that.
You collect the premium.
Yeah.
And you're basically betting that the floor created by that huge EPS guidance raise and the massive buyback program will prevent the stock from really collapsing to that level. It's a bet that the fundamentals are just too strong for a major drop.
A compelling idea.
Yeah.
Using the market's perceived risk, that high volatility, to generate income while betting on the company's proven profitability. So to wrap this whole deep dive up, CarGurus' Q3 really confirms their strategy is working.
Yeah.
They're shedding the heavy stuff and doubling down on their high-margin marketplace moat.
And that moat is getting wider and deeper thanks to this aggressive AI-centric software push. Products like PriceVantage and CG Discover, they're turning data into tools that fundamentally change how dealers operate.
And with that huge share repurchase program, they're just setting the stage for amplified, accelerated EPS growth into 2026.
And the final provocative thought we want to leave you with goes back to that $4 billion market expansion. As CarGurus pushes deeper into dealer workflow with these new AI tools, will this momentum eventually let them move past just being the lead generator? Could they become the central intelligence system for the dealership, making them a direct and frankly very formidable competitor to the traditional dealer management system vendors?
So will they become indispensable software instead of just a marketing expense? That is the billion-dollar question for you to think about.
Thank you for joining us for this deep dive into CarGurus Inc.
We'll catch you next time on The Deep Dive.